Somebody has to take the loss. The sovereign three-body problem facing America and Japan. Summary statement. The United States and Japan are caught in a sovereign three-body problem between fiscal sustainability, investor returns, and purchasing power. Japan spent decades suppressing government bond yields to preserve fiscal sustainability, pushing capital overseas in search of higher returns, and ultimately placing pressure on the yen. America now faces the opposite side of the same equation. Investors demanding higher Treasury yields at precisely the moment enormous debts and deficits make higher borrowing costs increasingly difficult to absorb. As Japan moves to defend its currency and America moves to support its Treasury market, the interests of the two financial systems increasingly collide. Both governments can try to balance all three objectives, but under sufficient pressure, the equation demands an adjustment somewhere. Fiscal sustainability. Investor returns, purchasing power, somebody has to take the loss. Section 1. The sovereign three-body problem. The easiest way to understand what is going on between the United States and Japan is with a simple equation from Economics 101. There is something called the policy trilemma, nicknamed the impossible trinity, or the Mundell-Fleming trilemma. The textbook version says that a country cannot simultaneously have free movement of capital, a fixed or tightly controlled exchange rate, and complete independence over monetary policy. You can have two, but eventually the third one has to give. I think there is another version of this problem playing out now in the sovereign debt markets. And conceptually, I think of it as the economic equivalent of what physics calls a three-body problem. In physics, every celestial body has its own gravitational field. The moon orbits the Earth and its moon orbit the sun. With two dominant bodies, the relationship is comparatively straightforward. One gravitational field dominates the smaller body. Introduce a third independent body, however, and finding equilibrium becomes vastly more complicated. The three bodies begin pulling on one another. Their trajectories become difficult to calculate. Small changes can produce very large changes in the eventual outcome. The system can become chaotic. That is the picture I have in mind when I look at sovereign finance today. Because the three bodies are fiscal sustainability, investor returns, purchasing power. Fiscal sustainability is represented by the government's ability to finance and service its debt. Investor returns are represented by the yield creditors require to continue holding that debt. And purchasing power is represented ultimately by the integrity and stability of the currency. You can try to protect all three, but under sufficient pressure, somebody has to take the loss. That is the sovereign three-body problem. And Japan gives us perhaps the clearest example. For decades, Japan accumulated an enormous government debt burden. In order to preserve fiscal sustainability, the Bank of Japan bought enormous quantities of Japanese government bonds and eventually came to own an extraordinary share of the market. For years, Japan formalized that suppression of government borrowing costs through yield curve control, or YCC. The objective was simple: keep government bond yields low enough that an enormously indebted government could continue financing itself without interest expense overwhelming the system. But somebody had to take the loss. If the Japanese government receives extraordinarily cheap financing, then somebody else is receiving an extraordinarily low return. That somebody includes the institutional investor, the pension fund, the insurance company, the retirement system. These institutions have long-term liabilities of their own. They have pensions to pay, annuities to fund, and customers whose savings have to generate a return. So Japanese capital searched overseas for yield, into the United States, into Europe, into other higher-yielding financial markets. This is one of the structural forces behind the enormous Japanese ownership of foreign assets. And here the three-body problem begins. Because suppressing domestic interest rates can protect fiscal sustainability, but it can simultaneously encourage capital to seek higher returns abroad. And that can put pressure on the currency. A weaker yen then means Japan pays more for imported goods, particularly imported energy and raw materials. Japan is an energy importing economy, so when the world experiences an energy shock at the same time that the yen is weak, the two forces compound one another. Japan doesn't merely experience higher commodity prices, It experiences those higher commodity prices through a weakened currency. That means imported inflation, higher input costs, pressure on businesses, pressure on households, and a deterioration in domestic purchasing power. Eventually, the government has to defend the third body, the yen, and that is exactly what we have now seen. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Japan intervened directly in the foreign exchange market to buy yen. And extraordinarily, in late July and early August 2026, the United States joined it. The U.S. Treasury participated in a rare coordinated intervention with Japan, with the American side selling euros and buying yen rather than selling dollars. That distinction mattered. Selling dollars would have signaled a broader American desire to weaken the dollar, potentially aggravating American inflation. Selling euros allowed the United States to support the yen while attempting to keep the intervention specifically focused on Japan. So now look at what has happened. Japan spent decades protecting fiscal sustainability by suppressing yields. That suppression contributed to Japanese capital searching overseas for investor returns. And eventually, the weakness of the yen created enough pressure on purchasing power that Japan had to intervene to protect the currency. Somebody has to take the loss. Now cross the Pacific, because the United States has its own version of exactly the same problem. America has now accumulated more than $40 trillion of gross federal debt. The federal government continues running very large deficits, and maintaining fiscal sustainability therefore requires continuously refinancing and issuing enormous quantities of government debt. But investors are not passive. If investors become concerned about inflation, deficits, currency debasement, or the government's future capacity to service its obligations, they demand a higher return. That means higher Treasury yields, and higher Treasury yields become higher government interest expense. Interest expense is already one of the largest items in the federal budget. On the conventional net interest measure used by the Congressional Budget Office, federal net interest is running at roughly $1 trillion annually, and now exceeds almost every major individual spending category other than Social Security. Recent reporting places interest as the second largest federal budget item, ahead of Medicare and defense, and behind Social Security. So America faces its own three bodies. The government wants fiscal sustainability, Treasury investors want adequate returns, and Americans want stable purchasing power. Once again, somebody has to take the loss. And this is where the United States and Japan become joined at the hip. Japanese institutions are enormous participants in global fixed income markets. If Japanese investors can suddenly earn materially higher returns at home, or if defending the yen requires Japanese capital to return home, the relative attraction of owning U.S. Treasuries changes. America therefore has an interest in preventing disorder in Japan, and Japan has an interest in preventing disorder in the American Treasury market, which is why the recent intervention matters. The United States has now helped Japan support the yen, and at almost the same time, the U.S. Treasury has begun taking increasingly aggressive action in its own government bond market. On August 19th, Treasury announced that it would at least double the size of its liquidity support buybacks of 10 to 30-year Treasury securities, from a maximum of $2 billion per operation to at least $4 billion per operation. The market immediately recognized the resemblance to an Operation Twist-style strategy: buy longer duration government debt, support prices at the long end, attempt to suppress long-term yields, and finance the government's broader funding requirement increasingly through shorter duration issuance and other available Treasury cash resources. But there is a catch. Changing the maturity structure of the debt does not eliminate the debt service problem. Imagine the government has $100 of debt carrying a 2% interest rate. That costs $2 a year to service. Now imagine that $100 is replaced by only $70 of debt. You might look at the principal and say, excellent, the debt burden has fallen by 30%. But suppose the replacement debt carries a 5% interest rate. $70 at 5% costs $3.50 a year. So the government now has less debt principal, but more interest expense. The quantity fell, the servicing burden rose. That is the trap. And to be precise, the current Treasury buyback program is not literally a dollar-for-dollar exchange of every long bond for a newly issued Treasury bill. Treasury says these are liquidity support operations, and Secretary Bessent has indicated that some purchases could be financed using the Treasury general account. But Treasury itself also acknowledges that over time, bought-back securities are generally replaced within the government's broader issuance program. So stand back and look at the whole picture. Japan is trying to protect its currency. America is trying to protect its government bond market. Japan spent years suppressing yields to preserve fiscal sustainability and eventually created pressure on purchasing power. America now faces rising yields because investors increasingly demand compensation for inflation and fiscal risk, creating pressure on fiscal sustainability. Japan wants a stronger yen. Japanese investors want adequate returns. America wants affordable Treasury financing. American investors want adequate returns. And both governments want to preserve the purchasing power and credibility of their currencies. Those objectives can coexist when the system is calm. Under stress, they begin pulling against one another. That is why I call this a sovereign three-body problem: fiscal sustainability, investor returns, purchasing power. You can try to protect all three, but when the system comes under enough pressure, somebody has to take the loss. Japan is increasingly trying to protect the yen and purchasing power. America is increasingly trying to protect the Treasury market and fiscal sustainability. And because Japanese capital sits inside the American financing system, one country's solution increasingly becomes the other country's problem. That, to me, is the equation faced by the United States and Japan, perhaps more visibly than almost any other major developed economies operating under the same basic constraints. The three bodies are still in motion. The question is not whether they pull on one another. They already are. The question is, which one eventually takes the loss?